Good afternoon, a very warm welcome to you all. My name is Pierre Schlosser and I am the Scientific Coordinator of the Florence School of Banking and Finance. It is my pleasure today to introduce and moderate our online seminar on bank lending in the age of digital disruption. New technologies are revolutionizing the way we live and work. One of the consequences of this megatrend in the banking and finance sector is that financial technology-led startups, also called fintech, have decisively entered the scene and are gaining solid momentum. Think, for example, of the Swedish startup INSEAD, specialized in payments technologies for small businesses, and which was recently acquired by PayPal at more than $2 billion. If I had to summarize a consensus view on fintech, it would be framed along the following lines. So far, the take-up of fintech products and services has been incremental, but it is pretty clear to everyone that if one or several fintech leaders alone or in partnerships with established incumbents, manage to break through on both the wholesale and the retail markets and earn customer trust, then the disruption brought about by fintech will have no glass ceiling. The growth rate of digital mortgage will be, in this regard, and in my personal view, a canary in the coal mine. Fintech was the thematic focus of the current issue of European Economy, called The Promise of Fintech. The journal formerly known as European Economy, Banks, Regulation and the Real Sector is a relatively recent online outlet edited by Giorgio Barba Navaretti, Giacomo Calzolari, Alberto Franco Pozzolo and José Manuel Mancilla Fernandez, who I think has joined us. It aims to combine academic, policy making and operational contributions. I had the chance to read some of their past issues for my own research, and I highly recommend the journal. Its online-based issues are a fantastic tool to get a fresh and critical perspective on key topics of banking and finance, such as NPLs, banking resolution, or cross-border banking. But let us go back to our seminar. We now know that we have a relevant topic, but we also have the relevant experts to engage with the topic. I'm very glad today to be in the company of Jean Dermine, who is professor on the Singapore campus of INSEAD. Welcome, Jean. Giacomo Calzolari, who is professor of economics at the University of Bologna and research fellow at CEPR. Jean and Giacomo's short bios are available on our website. Many thanks to both of you for being with us today. Before introducing the audience of today's online seminar, I'd like to spend 2 minutes to tell you more about our school, as we have a few activities coming up that could be of interest to you. Most of you know by now that the Florence School of Banking and Finance is a place where multiple generations meet to discuss and argue about cutting-edge topics of financial stability, risk management, as well as banking regulation, supervision, and resolution. You may also know that the school boasts a diversity of policy debate and training activities, and that our online seminars are therefore only the tip of the iceberg. If you go on our website, you will find, for example, our freely accessible annual ebooks, which focus on the relationship between banking and sovereign dynamics and encapsulate the strategic contribution of our senior conference speakers. In terms of executive education, we'll be hosting 5 residential courses over the next month that, given your expertise, could be of interest to you. In late June, we'll have a course on credit and market risk management with precisely Jean Dermine. In late September, we'll host a course on liquidity regulation that will look at LCR, NSFR, and a few other aspects of liquidity regulation. In mid-October, we'll have a training course on macroprudential policy implementation, looking at the famous buffers. In early November, we'll host an introductory training session on forecasting in economics and finance, so a course more adequately addressed to economists. And in late November, lastly, we'll have the second edition of our autumn school on banking resolution. Okay, so enough about us. Let's talk about you, the audience, the participants who are around 100 today, connected, following us from everywhere in Europe and the world. We have 45 nationalities represented, which is close to our all-time record. We have many people from European central banks. Banco de Portugal is leading the group this time, as well as representatives from the SRB, the ECB, the Commission, and BBVA. 40% of you are women, 60% are men. You have more than 8 years of professional experience on average. The thin majority of you are trained economists, but we also have lawyers and business backgrounds with us. Lastly, 64% of you have a master's degree, while 26% of you have a PhD and 10% a bachelor degree. Right, so it's time to start now. How will our seminar be structured? Well, Jean will provide his analysis and views on bank lending in the digital age for about 20 minutes. Giacomo will then react and complement the picture. Jean will, however, have a chance then to reply if he wishes to. In his first step, we'll open up the Q&A session where you guys will step in. In this context, I'd like to remind our speakers to stick to their speaking time. So let me stop here, leave the floor to Jean, and in the second step to Giacomo. Jean, can I ask you to please connect your camera and mic and to share them with the platform? And once this is done, the floor will be yours. Hi, Jean. Thank you. The floor is yours.
Okay, hello. First, I would like to thank the School of Banking and Finance of the European University to let me speak to you about bank lending in the age of digital disruption. I am indeed based on the INSEAD Singapore campus, where it is a bit after 7 p.m. in the evening. Let me tell you a little bit when I started to have an interest in fintech. It was about 4 years ago that I started to discover a series of new companies, new words, unicorns, ICOs, LendingClub, TransferWise. And then there was this comment of The Economist that fintech startup are nimble piranhas. They would go after the banking industry, taking pieces of banking and not much will be left. And then about 3 years ago, I was invited by the Banque de France, the French central bank, to write the first piece on digital disruption in the banking world. And that led 2 years later to an invitation from European Economy that has been co-edited by Giacomo Calzolari to go again into digital disruption. So at the time when I heard the word digital disruption, I said in French, déjà vu. Years ago, I was told that telephone banking would take over, that telephone companies would come and banks would disappear. And then there was internet banking in the year 2000, and then Microsoft would come in and the banks would disappear. Then more recently, we have our smartphone, artificial intelligence. And it is a fact that so far, the banking industry has responded very well by offering telephone services, internet services. So there's always this question, how much of digital disruption is a hype and how much is reality. My speak will, yes, and then sorry, in that paper for the Banque de France, I basically started to look at the main banking services to try to ask myself which one might be disrupted. And I organized the banking services in 3 columns. You can read the first one, refer to data processing activity, like the payment system, your debit, credit accounts, you're just moving numbers, brokerage of shares and bonds, and plus 1 share for one, minus 1 share for another. We are talking about moving data. And there it's clear that banking may not be the best companies in data processing. I mean, it's not a surprise that in China, Alipay, part of Alibaba, has today 500 million clients. In India, the new company Paytm has, I believe, 200 million clients. Okay, these are non-banks, high-tech companies controlling the payment system. But obviously, besides data processing, there are other activities of banks, some which are heavy on analysis of data. Clearly, when you lend to small enterprise, there's all the issue of evaluation of risk, monitoring of collateral, recovery of loans, in advisory services to corporation, advisory services in private banking. This requires a lot of data analysis, which is of course quite different from pure data processing. And then third, we should not forget that banks do something special because they have a balance sheet. And they take short-term deposits, they grant long-term loans. So we all know they perform maturity transformation. And of course, these are extremely useful services. They create liquidity to investors. You can access your short-term deposits. And then, of course, lending long-term 10, 20-year loan. This is useful for borrowers. So the big question was really whether the second column and third one could be challenged by newcomer. And today I will focus quite a bit on the case of LendingClub. I work in a business school and we like to study specific cases. And LendingClub is interesting because it is a totemic figure of the peer-to-peer lending industry in America. It went to an IPO in 2014. So it is quite interesting to follow a leader of that industry and to see how things have developed. On the website of LendingClub, for those who are not directly familiar with peer-to-peer lending, it explains what they do. On the left side, you have investors who want to invest, and on the right side, you have borrowers who need to borrow. And LendingClub is just a brokerage platform. It is not a bank, it is not lending money, it is just arranging for investors to finance loans. And to make it easier for investors to finance loans and to allow investors to diversify, they use a technology where on the left of the slide, they start with one loan, I don't know, a loan of $10,000, a loan of $20,000, and they transform it into a series of small notes denominated in pieces of $25, which means that for investors who want to invest in loans, you do not have to put all your money into one loan, which would be pretty risky because of lack of diversification. But you can invest in these little pieces of $25, and investing in different loans, of course, allow you to diversify your portfolio. So clearly the technology is of course challenging for a banking professor. Is it really the case that banks will disappear and that peer-to-peer lender will replace banks significantly? I will show some numbers later on the number of peer-to-peer lenders in quite a few countries. But just a simple reading of newspapers shows that peer-to-peer lending has been now taking place in quite a few countries, including China. Just mentioned in red, Izubao, which was the largest peer-to-peer lender, was closed by the authorities in December 15 after it had managed to defraud 900,000 investors for the amount of $7.6 billion. In the case of Izubao, it was a pure Ponzi scheme. They were collecting money from investors to pay the previous investors, and money disappeared in the process. So before I continue, I'd ask the Institute whether we could get a feel of the audience as to whether they were going to take the view that peer-to-peer lending will seriously disintermediate incumbent banks, and you find out the question on your screen. And what do I mean by peer-to-peer platforms very seriously disintermediate incumbent banks? It is, let's say, if in 5-10 years' time, you would think they would capture a market share of more than 30%. Okay, so my question, if you can answer please yes or no, do you believe that in an horizon of 5 to 10 years, these new peer-to-peer platforms will disintermediate banks by, let's say, more than 30%? Okay, we give you a few seconds to vote. And then I know the organizers will show us the result of the poll on the screen in a few minutes, in a few seconds. Yes, so I believe that the poll is complete. In case you do not see the figures, I see at the moment that 35%, so about a third of the audience, take the view that peer-to-peer lender will be significant competitors to incumbent banks, and 2/3 take the opposite view that peer-to-peer lenders will not disintermediate banks in a significant manner. So thank you for taking the part. It's always interesting to get a feel for the audience. Now let me turn back to the presentation and take you to the story of peer-to-peer of the peer-to-peer lender LendingClub. And again, the reason to focus on a significant case is to understand a little bit better how things have developed and what are the challenges. The LendingClub company was created by a French lawyer, Renaud Laplanche, who was working in the Silicon Valley, and created the company in 2006, 8 years later, being able to take the company through an IPO in New York. LendingClub got tremendous visibility at the time of the IPO, partly because it had a prestigious board with John Mack, former CEO of Morgan Stanley, sitting on the board of LendingClub, the very famous Larry Summers, professor of economics at Harvard University, former president of Harvard University, former US Treasury Secretary under Bill Clinton, being member of the board. And at the time of the IPO, there was a lot of tam-tam, a lot of noise, that the peer-to-peer lending was coming out of the banks. The idea that they would be using the best technology, very low-cost internet platform in San Francisco, no expensive physical branches. Therefore, they would be able to give better return to investors, and also they would be able to provide cheaper loan to borrowers. So all good for all parties, except for the banks that would be disintermediated. This slide comes from the annual report of LendingClub at the time of the IPO. It was showing you the exponential growth in lending activity of the company. And at the time of the IPO, I went to look at Credit Suisse prospectus recommending the investments in the shares of LendingClub. And I was very curious about the financial model as to how to value LendingClub. And basically, it functions like an investment bank. At the top, it originates loans. Its revenue, its cash flow revenue, is by earning some fee on transactions. And then it pays all kinds of costs. Credit Suisse forecasts cash flows. You do typical finance discounting to give us a fair value per share. And I will show you the parameters that were proposed by Credit Suisse 4 years ago at the time of the IPO. In the same report, Credit Suisse was referring to what is called in the digital world the TAM, the total addressable market. This refers to the potential market for a new digital company. You can see the third bar refer to the total amount of consumer lending in the USA. This refers to unsecured consumer lending, that is excluding mortgages. You can see the total adds up to $873 billion in 2014. If you include unsecured loan to small and medium-sized enterprise, the potential target goes up to $1.1 trillion. On the left was the amount of LendingClub financing in 2014, $4 billion. And Credit Suisse was taking the view that the potential target for LendingClub after 10, 15 years is that they should be able to reach financing of $380 billion, which would be about 1/3 of the market. Now, where are these assumptions coming from? This is with reference with other parts of the digital world, reference to the Amazon in e-commerce, reference to Booking.com in travel industry, to see that successful companies in the digital world have been able to capture fairly rapidly a significant market share. Now, in the financial model, now giving you some parameters, Credit Suisse, so that was in 2014, was having a forecast for the next 10 years of business growing by 41% every year. Again, very rapid growth, but again with comparison to the Amazon of the world, to the Booking.com of the world. Credit Suisse were assuming a fee on loan. It was forecasting that the profit margin before depreciation and tax would go up from 9% to 35%. So clearly a case of economies of scale as the business will grow with kind of fixed costs on the San Francisco platform. The profit margin will grow. They were doing their forecast and then doing straight present value discounting, ending up with a fair share price of $24 per share. At the time of the IPO, the shares were sold to the market at $15 per share. So IPO at $15 per share. And the issue and the Credit Suisse report was recommending a fair value of $24, so clearly a bargain. The implicit price to book for Credit Suisse was a price to book, so value of shares over equity of 7, which should be very much in line with what you see today for companies like Apple, Alibaba, trading with price to book of 7. And then, of course, before we get overconfident in the process, we know that we always have to be a bit concerned with risk factors that can derail the process. And so, thinking about the risk factors that concern the peer-to-peer lender, before I tell you what did happen to LendingClub after the IPO at $15. I've organized the risk factors in 3 categories, because as economists we like to talk about supply and demand. Then also a few words about the business model. The first question concerns whether there would be enough investors to finance the growth of LendingClub. Several reasons why question mark. The first one was that interest rates were extremely low in the USA because of quantitative easing. There was going to be the question with interest rate going up, as it is the case today, whether investors would still have an appetite for this kind of product. The second question concerned that the loans of LendingClub, I have not yet mentioned, are typically 3 to 5 year fixed rate maturity. These are essentially illiquid products. As an investor, when you invest in the loan for 3 to 5 years, your money is locked in. And then there's a question for retail investors, whether they would be willing to switch from bank deposits to a LendingClub product. In a sense, the comparison of LendingClub that banks offer low return on deposits and LendingClub offer high return on its products, it's a bit unfair because bank deposits liquid like savings deposits. A LendingClub product is a 3 to 5 year fixed term investment. This is almost the point that very quickly LendingClub started to be short of funds in the retail market, and then they turned to the institutional market, hedge funds, pension funds, life insurance companies, or the banks to get the funding. And as many of you know, the peer-to-peer appellation disappear to be replaced today by what is called marketplace funding, referring to financing by institutional investors. Of course, this was another question as whether this money will be volatile or not. It's well known that institutional investors, one day may have a preference for bonds, another day they may prefer to go into equity, into a currency. So the volatility of funding might be an issue. On the issue of demand for funds, I will comment on that again, but it has been noticed that the demand has been fairly weak, with today apparently a lack of awareness of clients. I have not mentioned, but for LendingClub, 90% of the loans are not new loans, they're essentially refinancing of existing loans, like expensive credit card loans or expensive car financing loans. So you see that many borrowers are still willing to borrow at high interest rate on credit card when LendingClub would offer cheaper loans, and a bit of a mystery as to why the demand is not stronger. The last point concerning the risk concerns the business model. There is the obvious fact that soon enough, as a peer-to-peer company becomes large, it will attract regulatory attention. Regulatory attention both from the point of view of protecting retail investors, but also from the point of view of protecting borrowers to ensure that people do not borrow too much. Also, issue of the business model is that it is clearly a market with fairly low barriers to entry. The cost of setting up a platform must not be so expensive. And this is a business where network effects do not exist. It's not like a Facebook where it's important to have many people on the same platform. In the case of borrowing, you can borrow from one platform or another. The issue of network effect may not be so important. So there's an issue where the competition might kick in and might reduce the projection. So having in mind these risk factors, which of course apply to any peer-to-peer lenders, let's see what did happen to the share price of LendingClub. As you can see to the left, on the day of the IPO, the share price moved from $15 to $24, even $25. Of course, a huge increase, and that was hailed as a huge success. But then you can see since the share price has been a significant decline, and to the right of the screen today, being close to $4 per share. And most important, we have a price to book of 1. The value of shares over equity equal to 1, meaning absolutely no value creation. For a digital company, a disruptor, a price of book of 1 is of course not fantastic. The main reason for the decline in share price, it is simply that the expectations in terms of growth and cost control have not materialized yet. And then on the way, LendingClub hits some issue. In May 16, it had to ask the resignation of its founder, CEO René Laplanche, because of issue of mis-selling. And more recently, in fact, 2 or 3 weeks ago, well, a month ago, in April 18, the Fair Trade Commission has brought a legal action against LendingClub for failing to comply with various regulations, apparently issues of hidden fees in contracts and lack of privacy. Now, it's only an action. LendingClub takes the view that now things are under control, and we will see. Now, you should not read from my presentation that I am totally a person who does not believe in peer-to-peer lender. In fact, if you read the recent investment banking report, they are still somewhat positive on the industry. But I can still only observe that if I compare the figure 14 to 17, so 3 years, if the net revenue did increase by 39%, so which is of course impressive, the surprise that so far the operating expense have grown over 3 years by annual rate of growth 44%. Yes, that includes litigation costs, but even if I exclude litigation costs, the annual growth of expense has been of the order of 39%, meaning therefore that so far economies of scale have not yet materialized. In March 18, a large investment bank was observing that LendingClub represents only 3% of the total addressable market, meaning that the potential for growth is large. And this investment bank was still bullish on the possibility of LendingClub to grow. For me, 2 issues have to be solved, at least have to be answered. One is the issue of awareness. Why is it that so many potential clients do not take advantage yet of lower interest rates? And the second question, in the financial market, will there be enough long-term money from institutional investors to build up for 3 to 5 years in this kind of product? So that's a big question, the availability of long-term money to finance these investments. But I can certainly believe that pension funds life insurance companies may wish to invest part of their money in these products. So therefore, clearly, if the early years have been difficult, one should not rule it out completely. Given the time, and I need to be fair to the discussants, let me skip just one or two slides. On this slide, by the way, it reports, not for 2106, sorry, for 2016, the number of credit platforms. I was amazed that in France, as an example, there are 53 peer-to-peer lenders. I must say I've never heard of them. No surprise, in the big country of China, you have 356 platforms. So clearly a lot of activity, therefore fairly low barriers to entry. And the last, yes, and then to last point, you could say that taking LendingClub is a bit of a special case, but on this chart, I report in yellow the share price of another peer-to-peer lender, which is also very large liability in America. This is On Deck Capital. On Deck Capital is a partnership with JP Morgan. They are focused on lending to small enterprise. As you can see, the share price has also been in sharp decline in the last 3 to 4 years. Last, skipping this, issue of regulation. I think they are still to be developed. Clearly, competition is good, but it has to be fair. We do observe that peer-to-peer platform are allowed to lend to sell the full credit risk to investors. We know after the banking crisis that in the case of securitization of loans, banks have to retain part of the risk in their book. So there seems to be somewhat unfair competition between peer-to-peer lender and the banks. Obviously, there will still be issue as how to protect not only investors with proper information, but also borrowers. In America, the banks are responsible to make sure that borrowers do not borrow too much. There's a question whether peer-to-peer lender should also have some responsibility in facilitating loans. And then third and last, market-based funding is taking place outside the banking system, so this is becoming a part of shadow banking. We know that massive liquidity risk took place in shadow banking during the crisis. So clearly one would wish that regulators monitor extensively the importance of market-based funding in shadow banking, and in particular the question of maturity transformation and whether or not liquidity risk would arise as well. It's been a bit over time, so I think I will let it now to Giacomo Calzolari to bring his comments.
Thank you very much, Jean. If Giacomo could go online, so we're putting up the slides. So Giacomo, just start your webcam and share it with the platform, please. Here we go. You're closer to us. Jean was 10,000 kilometers away, so at times the sound went away. Apologies for that. But now the floor is yours. Thank you.
Thank you. Thank you. Thank you, Pierre, for having me, and also for the nice introduction that you gave to our new journal, European Economy, where with Jean Dermine and other co-authors, we have recently worked on fintech and the relationship between fintech and banking with this question mark, you see friends and foes, and also of course thanks a lot to Jean for his really insightful talk. I think the bottom line is that we agree, and so let me just mention a few facts summarizing the idea that innovation per se is great and neutral, and we all welcome technology applied to finance. And but also we know that banks are multi-product firms. They rely on economies of scope and in three main activities, bundling together three main activities: maturity transformation, information processing, and payments. So the fact that banks are bundling these activities all together, we think will make direct competition for the entire banking business difficult for, if not impossible, for fintechers. There will be certainly, at least this is our view, some competitive pressure generated by these new firms. Competitive pressure, as Jean was saying before, it's again, it's welcome. If you look at the little chart on the right hand side of the top right hand side of the screen, what you see is the actual secular stability of the cost of financial intermediation to the side of the user, which is, I don't know if you see the scale of the graph, but it's pretty stable over more than 100 years. So competitive pressure is welcome, and then we can imagine there will be some unbundling and some disintermediation due to the arrival of fintechers. I also agree with Jean that there may be a risk if fintechs remain, let's say, in the shadow of shadow banking, if it's becoming the new shadow banking, and we think it's important that users of fintech platforms are aware of the product and the services that they are buying. And the last point we also agree again is that regulation must play a key role. And we think it's important that in the coming year we eliminate any source of regulatory arbitrage. And here we are suggesting that regulation will take place by function and not by subject. I'll spend a few words on this in the next slide. So the idea is that there must be leveling the playing field, and at the same time we should avoid, the chilling effect that regulation may have on innovation. So in terms of regulation, let me just mention that if you look at the chart on the right-hand side, what you see is the large heterogeneity in the different approaches, at least for in European countries, of the approaches with respect to regulation in fintech. You go from a few countries experiencing and experimenting the sandbox approach to other countries that have more specific and different approaches, to a large fraction of countries which currently do not have specific approach to regulation of fintech. And if you look at the left graph on the other hand, so let me here make a preliminary statement. Clearly, I'm not claiming any causality here, but if you look at the graph here, you have on the horizontal axis the stringency, a measure of an index of stringency of regulation, and the vertical axis you have the investment at the level of a country on fintech, and there is a kind of slight but significant negative correlation. So the more stringent is regulation, the less is currently the investment on fintech. So again, I don't want to claim any causality here, but it's important to understand whether the diffusion of fintech is taking place also because of regulatory arbitrage. So what we mean for regulation by function is, if you take, for example, the case of crowdfunding platforms, well, if these platforms collect deposits or something that is related to deposits and they keep risk on the balance sheets, then they should be considered as and facing banking regulation essentially. They should face portfolio management regulation if the platforms has instead discretion in selecting potential borrowers. Payment service regulation should apply if platforms collect money without third-party payment services. So this is what we mean for regulation by function, and we think it's important that this is kept in mind. So what about the scenarios? Again, with Jean, we agree on this. there will be probably some convergence that we already have started seeing, so with some banks adopting new technologies, some fintech companies expanded the range of their activities, and regulators treating, hopefully, we think, fintechs and banks similarly for similar activities. So what we think is that there may be casualties here which probably would not be banking activities, but probably some types of banks and some, and as a consequence, some jobs in the banking sectors. And some signs of these facts are already been seen in the US, where there is this recent paper by Buchak and others, where they show that rural and small commercial banks are starting losing for lending to the benefit of peer-to-peer lendings. So fintechers are, able to crunch vast amount of hard information, and with this respect, a possible consequence could be that there may be some cherry picking by fintechers towards more transparent borrowers, for example. To some extent similar to what happens when foreign banks enter some countries. But we think that still that, let's call the dirty work of working on soft information will remain in the hands of the banks. What I mean with soft information is, for example, trying to answer what is this question: how can you define a trustworthy entrepreneur? So it's something that really relies on a lot of information and also direct communication. So the distinction between soft and hard information and this separation of activities between the typical activities of banks and new activities of fintechs will resist as long as artificial intelligence and development will allow. So let me tell a few words on artificial intelligence and machine learning, and with this respect, I think we really need to know more. This is my impression. So what the machine learning does, of course, simplifying a lot without making any justice to computer scientists. So machine learning softwares are great at pattern recognition, and all this started on image recognition. So we know that currently, actually from last year, machine learning softwares are better predicting, for example, heart attacks than the widespread protocol of the American College of Cardiology. And so if you think about what is creditworthiness classification, is actually nothing else than pattern recognition, whether a borrower is creditworthy or not. So we can really expect new and many applications in the credit marks of these artificial intelligence tools. And I think the required investments to enter these type of activities is not really huge. But as I said, we really need to know more, and I would like to conclude just telling a few words about the risk of what we don't know, with a couple of examples. So you may know this activity that is going on between computer scientists that is called adversarial imaging. And the idea is that if you appropriately manipulate pictures, you can fool these tools, these machine learning tools. And this is when you start applying this to credit worthiness classification, can be kind of risky for lenders, borrowers, and society at large. So let me just give you an example. So the picture I'm going to show you next is what the top-notch Google visual recognition software classifies as a rifle 99% of the time. And this is the picture, which is, as you can see, is not really a rifle. So we really need to know more, and would like to conclude with kind of a little bit of advertising. I'm working with a group of colleagues, asking whether and seeing whether machine learning and algorithmic pricing can learn to collude in markets. So The punchline is, I think I fully agree with Jean, the jury, and the final word on what is going to happen between banks and fintechs, and bank lending and fintechs is still in there. And summarizing, I think it's really important that regulation plays a role here in leveling the playing field and allowing technologies to enhance and get the best from this new competitive pressure. And I think I'm really done, and I'm very happy to hear about the comments of our listeners and viewers. So
thank you very much, Giacomo. So if Jean could come back on stream, this would also give him the opportunity to react to some of the material you brought up, Giacomo. And then in a second, Jean, would you like to react, or shall we move immediately to the Q&A?
I believe, given the time, you may wish to move directly to the Q&A, and then maybe on the way I will comment or make some comments on the comment of Giacomo.
Okay, that's great. So to everyone listening, please type your questions in the chat box. I can see that some of you are already typing. May I, just to get us started, ask, because we're talking about competition also in banking in this seminar, whether what was exactly the acquisition speed of new fintech companies? Because that's a usual way actually for incumbents to sort of limit the impact of the disruption, is basically to acquire them at a high price and maybe then steer the technology to a benefit of their own. So is this something that is happening fast, or is the market still determined by small actors who are on the fringe and are not operating in the shadow of incumbents?
Pierre, you want me to respond to that one? So
Please.
I think you have two types of actors. You a series of small fintech, relatively small fintech companies which are independent. A good example is I mentioned the American on-deck capital organizing loan for SMEs. There was a question whether or not they would be bought by JP Morgan, but in the end they decided to keep their independence and just have an agreement with JP Morgan. So I think we see a lot of small ones. At the same time, an interesting question for me in Singapore, being closer to China, it is to see the enormous Alibaba company, the equivalent of Amazon. As we know, Alibaba, with more than 500 million clients, entering financial services with extremely large subsidiary called Ant Financial. And so it is interesting to see whether Alibaba, extremely big in China, is now moving abroad, in particular in Southeast Asia, in Thailand, Singapore, trying also to go to the US. So that would be interesting to see whether this enormous company from China, how are they going to succeed abroad? That would be interesting. But to my knowledge, we have not seen that much acquisition in that field yet.
Okay. Before giving the floor also to Giacomo, maybe we can connect that past question to what Katarina has put down on the distinction between banks and fintechs. And she's basically wondering if you could be more explicit regarding two potential evolutions regarding lending platforms. So the role of big tech, on the one hand, Facebook, Amazon, Google, entering the platform lending business, and incumbent banks, I guess, on the other, starting their own platforms.
Yeah, so this is the big word today, the word of platforms, and that's interesting for English economists, where today banks on their platform may not even want to develop all the services themselves. As an example, in Singapore, Development Bank of Singapore, the largest bank in Singapore, has put on its website 300 different banking applications where they invited third-party provider to provide services. So indeed, the big word is platform, whether it's a Google, whether it's a bank, they all want to have a platform and the idea is the idea is to keep the customers and then to sell the services. So let me just expand on that one and to relate to Giacomo. I think it's an interesting question for economists and regulators about what's going to happen to big data. Today, it seems to be that having access to a lot of data is a fantastic asset. And there are big questions about economies of scale. Is it the case that the very large Amazon having much more data, the Alibaba of the world, the large Google of the world, is it that because there's so much data, is that going to lead to natural monopolies, which in that case a state should intervene? So of course it's too early to tell, but that I think it's certainly an issue that will have to be monitored.
Giacomo, also if you could connect that question to the question by John Frost about, again, the big tech versus fintech startups.
Yeah. I think there is one element on which I'm not fully agree with Jean, and it's the point where Jean, you mentioned that network effects seems not to be very important, and you are right in the strictly speaking, network effects are not necessarily key here. But if you think a platform like Amazon, how it works currently, Amazon with its marketplace, well, it works very well among other things because it has generated a thick market where you have a lot of demand and a lot of supply and the ability and they are able to make the match between the supply easier because they are attracting a lot of people searching either to sell or to buy. And so with this respect, I think if on one hand, even if on one hand, as I said, investments in order to set up these platforms are not huge, then the ability to attract many interested people may be key here to the success. And replying to one of the questions that I see around on P2P platforms, the big tech may become important players if they decide to enter in this business. They may become important players because of this large audience that they already have. Of course, they will face the same problems, as the others in terms of source of funding, which I agree fully.
If I can add one point on this one, that is the question of Jan Frost, the competition between the big tech firms and the fintech startups. I mean, indeed, people do mention that today Amazon is very much involved in lending, and that it's a big competition to the banks. For me, I think it's a bit of an unfair comparison because Amazon is basically replacing all the supermarkets. If you think a company like the French retailer Carrefour, well, Carrefour for many years has been lending money to consumers. Carrefour is buying goods for small companies. So Carrefour has been giving financial terms, accounts payable to these companies. So it seems to me that retailers, for a long time, have been lending to consumers and for small companies. So the fact that today Amazon or Alibaba is doing it, to me, this is nothing new. They're just replacing what was done by other retailers. Now the question is whether having access to more data, indeed, is it going to be more important than retailers were doing in the past? That remains to be seen.
Okay, thanks. There was a question by Chiara on the investor protection strategy in P2P as described in the case studies. I think that's a question to you, Jean. She's making the distinction between small individual investors and in institutional investors, as pension funds that you mentioned and insurance companies.
Let me first make the distinction between protection of investors and then after the issue of protection of borrowers. As we know, different countries have different attitude vis-à-vis the protection of investors. Some countries are more paternalistic, like Singapore. Other companies are more liberal. But as an example, when you go on the platform of LendingClub, they show you the return on investment over the last 2 or 3 years, and they show you these are very safe investments. Now, in my opinion, this is totally misleading information, because if the US economy has been doing well the last 2 or 3 years, no surprise that lending has been profitable. Really, what you like is for investors to understand in a downturn economy, okay, what is at risk with this product. It seems to me today that no information is being provided, and therefore I'm a bit surprised that we regulate the sale of some products to retail investors when peer-to-peer products do not seem to be regulated. I just would be a bit nervous as a regulator to see what will happen in the downturn when investors would start to lose money and they would start to complain, why was it not said before? I mean, we know investors lost a lot of money in the US subprime crisis. It seems that we have a complete repeat of history. Now, that will concern, of course, retail investors. Of course, instrument investors should be able to understand the risk themselves. Then the other question, which I think is also quite serious, concerns borrowers. I think in most countries today, in particular after the crisis, it is the view that the banks must make sure that borrowers are able to pay back their loans. A bank can be taken to court if it does not analyze properly the risk. Again, it would seem that fintech lending should be somewhat regulated. Now, the question is, how is it going to be done? Because the fintech is not lending directly, it's inviting investors to lend. There you wonder whether the authorities that today most countries collect information on individual borrowing in their credit bureau, you wonder whether authorities may not have a role to monitor the borrowing of some persons, and at least to ring an alarm bell if somebody is borrowing too much. But I think this issue of fair competition will become increasingly important between this peer-to-peer lender and the banks.
Giacomo, would you like to complement? I mean, perhaps we could hook this up with the question that there was on the nexus between competition on the one hand and financial stability.
Yeah, we know that this is it's an issue. Intense competition in financial markets may somehow be incompatible with stability. But still, I think it's when you see this graph of the actually stable users cost of financial intermediation over the 100 year, I think some competition, provided that the regulation will take place and treat everybody equally, some competition should be welcomed in this area. So I see one question, if I may, by Evelyn, which is somehow different from the others, and I think it's interesting whether peer-to-peer platforms could mobilize capital in developing countries. I think it's interesting. I think my view is that yes, this could be the case, and to some extent, the diffusion of payment systems through smartphones in developing countries is really showing that what is the potential of these technologies, and the fact that they can be really beneficial to people they have not access to banking services.
Okay, thanks. There is a question. I'm not sure to what extent you're familiar with the FinTech Action Plan of the European Commission. If you are, please engage with the question. If you're not, we will move to another question.
No, I am not directly familiar.
Okay,
No,
no problem.
I would go on.
So
Yes.
a question by Michael on the fact that P2P system cannot create credit as banks do. And so basically is referring to liquidity. And asking, shouldn't this be a great limitation for the development of the market, that they cannot have access directly to credit?
If I can try to answer, I guess from a macro monetary perspective, we know that the central bank control money creation, and that leads typically in an economy to a total volume of credit in an economy. And the volume of credit in the economy may go partly to the banking system, partly to the bond market, or can go to peer-to-peer lender. So I'm not concerned, or I'm not sure that because they do not create money, peer-to-peer lender will naturally have a size that is limited. For me, I think the total size of the credit market is kind of controlled by the central bank. And then the total credit market is going to be split between different actors. And therefore, I think in principle, the peer-to-peer lender in principle could take a big part of the banking activity. Yeah. But Giacomo may be better positioned to answer that one.
Yep.
Yes. No, but I think I agree with you on this. Yes.
Yeah. So we can talk. We can try to address in the remaining 2 minutes the two last questions. One was more on supervising P2P and cryptocurrency. So I don't know whether it makes sense to bring the two together. You tell me. And then the last question was about P2P lending platforms, incentives, and abilities in managing credit risk. So that's more maybe a point for Jean.
Yeah, if I yes, I agree with you that cryptocurrencies and peer-to-peer lending, they're the different businesses, and I agree. So here, supervision, it's a kind of daunting task. It's a difficult task, and supervisors should really organize on with probably teams specialized on supervision on these activities. So I know that also I was mentioned before about algorithmic pricing, which is of course it's related to what we are talking here. I know that competition authorities are asking similar questions here. No? They are asking how can they supervise markets, seeing whether these algorithms that are used now more and more frequently to price products are pricing properly in a competitive way, let's say, and so I know that these authorities are asking how can they supervise this market, and so I think there is no answer yet. The sandbox approach is one possibility, which means having these algorithms work in a virtual environment before freeing them in the market in order to see how they cope, what's the behavior of these new tools. But this is one of the approaches that is available, and I think there is a lot to do.
Jean, on the credit risk management.
Yes, if I can make a few comments. So I come back again to the issue of protection of investors. It's a bit surprising that with MiFID II, as an example, the banks has to discuss with the clients what are the risks when you buy shares and so on. And it's a bit surprising that peer-to-peer lender offer basically zero information at what will be the risk in a recession. So we're inviting investors, retail investors, to invest in loans where absolutely zero information is provided as to what will be the risk in a downturn. That is a bit surprising. On the last question of Francesco on the incentives of peer-to-peer lender, for me, I will not compare their incentives to those of banks, but I would compare their incentives to those of rating agencies. Okay, because what they do on the platform, they basically rank the loans according to different level of risk, exactly like a rating agency would give a rating to bonds. And we know very well that there's been problem with the rating agency as to what were the incentives to deliver good ratings. You may see the same with peer-to-peer platform, that the incentives to deliver proper ratings may not be good enough. And although one may say that China is special, there is today a major crackdown of the Central Bank of China on these 300 of peer-to-peer lenders, and a crackdown to exactly verify that they are doing a proper job in rating loans. Because like a rating agency, the risk is with the investors, completely, 100% with the investors. So, yeah, so for me, lending platform is much more similar to rating agencies than they are to banks. Pierre, if you allow me a last comment, I want again to repeat for me that we should never forget the important role of a bank balance sheet in being able to take short-term deposits and make long-term loans. And to demonstrate the importance of balance sheet, it is quite symptomatic that the famous Goldman Sachs has now started to create in the US a consumer bank called Marcus. By the way, a consumer bank that they plan to take to the UK and apparently also to Germany. And Goldman Sachs is exactly attacking LendingClub. They are also lending to consumers. But instead of selling the loans to investors like LendingClub, they keep them on the balance sheet of Goldman Sachs, which is financed with deposits. Okay, that's clearly, I find it very, very interesting to see a new competitor not taking the peer-to-peer model, but taking, of course, a platform with low cost, but it's a pure banking model, because that allows them to take short-term deposits to finance loans. And that's, for me, a great example where a standard banking model with low cost, a platform, may be a competitor to a LendingClub, peer-to-peer kind of lender. Of course, it's only an example, but I think coming from Goldman Sachs, it's a very, very significant example.
Sure. Thanks. That was a very, very telling illustration. Giacomo, would you have some final remarks?
Yeah, so I was just thinking about it's somehow related to some of the questions here, probably the last one on the incentives, and it is also related to some of the comments Jean did about the business model, the risk of the business model, and I think it's important to know that some of the revenues that these peer-to-peer platforms are obtaining, it comes from, let's call them participation fees, which is a kind of different approach to revenue and may, in a sense, generate a strong incentives to increase the traffic, in a sense, no, the number of transactions that go through the platform, which doesn't sound really as the best approach in order to have a proper screening of
Okay.
what goes through.
Thank you very much. This seminar is drawing to an end, so I hope you enjoyed it as much as we did. I'd like to warmly thank our speakers for their time and dedication, and of course all of you for your very relevant questions and for watching us.